Hello there, Dorian Daily listeners, and welcome to the 7th episode of the Dorian Daily podcast. Our quote today comes from the great Albert Einstein, and it reads, "The hardest thing to understand in the world is the income tax." And I believe he said this to his accountant, his tax accountant, and the accountant replied, "That's what you have me for." And it's pretty funny. And it also speaks to the topic of today's podcast, which is the basics of tax, and specifically how you as a Canadian can save a lot of money throughout the course of your life trying to minimize tax to the greatest extent possible. And while everyone's tax situation is unique, I think that if you follow the advice put forth in this podcast, you will be able to save hundreds of thousands throughout the course of your life, just by doing some of the general best practices with respect to the tax system. So in Canada, we have what's called a progressive tax system, meaning the more money you earn, essentially the higher your tax rate. And the important tax rate is the marginal tax rate, which is how much you pay on each additional dollar of income. The highest marginal tax rate in Ontario right now is 53%. And I think that's pretty insane. I mean, like, in what planet do you work hard and you have to give away more of the money than you actually make? And I understand there's various social programs, universal health care, policing, fire service, national defense, maintenance of roads and highways. Although, as Walter Block, he's a libertarian author, wrote in his book, Privatization of Roads and Highways, his thesis was that would be better left to the free market economy as opposed to the governmental bureaucratization of transportation. But that's neither here nor there. Purpose now is just to show you how much you're paying in tax and how you can minimize that tax. So the average tax bill for a Canadian family making $85,000. So take that husband, wife, or partners who together earn 85 grand is probably about the average Canadian family. You're paying income tax, payroll and health tax, sales tax, property tax, profits tax, liquor, tobacco, amusement tax, auto and fuel tax, motor vehicle license taxes, natural resource taxes, import duties. If you made $85,000 last year, you would be paying $37,000 in tax, so 43%, and that's just the average Canadian family. And in Ontario, you even have a surtax, which is a tax on tax. There's no surtax at the federal level. Sorry about that. There's no surtax on tax on tax at the federal level, although as per the Tax Act, they can invoke one. But Ontario, if you are paying tax greater than $4,740 to the provincial government, up to $6,067, you pay 20% tax on that tax. And then the second tier is if you're paying tax which is greater than $6,067 to the provincial government, you're paying 56% tax on that tax. It's nuts. It's really nuts. And then it's not just on income, it's also on your investments. So capital gains tax, dividend tax, interest income tax. It's never ending. So I'm going to keep bantering on about how much tax there is. Let's talk about how exactly you can minimize your tax burden. So the three primary vehicles I'm going to talk about today are the tax-free savings account, which was introduced in 2009 in Canada, a registered retirement savings plan, which was originated in 1957, and then the defined benefit pension and the defined contribution pension. If you do have a pension at your work, vast majority of people in Canada, it's a defined contribution pension. And then the public sector, a lot of public sector workers get a defined benefit pension, or at least access to a defined benefit pension. Whether or not you contribute to it is up to you. So if your employer offers a defined contribution pension and they offer a match, it's generally best practice to to contribute to that up until the matching point, because A, if they match it, that's like 100% return on your investment right away. It's basically free money. And B, you're able to minimize your taxable income for that year by contributing to it. So for those that don't know, defined contribution plan is a corporate sponsored pension plan, which may be employee contributory or non-contributory, meaning that the employee assumes all the risk with respect to asset allocation and investment monitoring. And contributions to the defined contribution plan affect your registered retirement savings plan contribution limit. So again, if it's generally best practice if your employer matches your contribution to the defined contribution plan to just invest in that, because even if you change employers, you could potentially roll it over if it's like with one of the big insurance companies like Sun Life or like Manulife or whatever. But if you can't roll it over to the new employer, then you can just like put it into it just transfers into like a LIRA, which is a locked-in retirement account. And then you can't touch it until age 55, and then you can do stuff with that. But the defined benefit plan, same thing as corporate sponsored pension plan, where a defined pension or income payment is determined based on your years of service of the company and your income level. And the same thing, it can be employee contributory or non-contributory. And then contributions also affect your registered retirement savings plan. And that's a lot of the reason why these unions bankrupted a lot of corporations. Like you look at the big automakers in the United States, like General Motors and Chrysler, Dodge, Jeep. These defined benefit plans were just like killing the cash flow of the businesses, and that's why a lot of employers are now switching to a defined contribution plan, because they're not required to pay like a certain amount of money to the retirees. And the risk essentially falls on the employee, whether or not the value of the pension goes up or down. Whereas in the defined benefit plan, the risk falls on the employer, because they're required to pay a certain amount of money regardless of how well the pension fund is doing, whether it's like going up or down. They still have to pay out the same money. So again, ask your employer, what the pension plan is like and whether or not they do matching for your contributions. And if they do up to a certain dollar amount, great, do that. Reduces your taxable income. So you'll be paying less income tax, and you'll also be getting like 100% return up to the matching limit. But for those of us whose companies do not have a defined contribution plan or defined benefits plan, there's still tax savings to be had. So don't worry. The two main vehicles are a tax-free savings account and the registered retirement savings plan, also known as the TFSA and the RRSP. So with respect to the TFSA, it doesn't actually reduce your taxable income insofar as the money that you put into your tax-free savings account is after tax dollars. So you've already paid income tax on the money, unfortunately. However, any gains, like investment gains that you realize in the tax-free savings account, they are not taxed at all. So whether you get dividends, whether you get capital gains, or whether you get interest income, it's 100% tax-free. And that's really, really good, because usually, like outside of a non-registered account, like TFSA and RRSP, they're both quote-unquote registered accounts. If you have like a non-registered account with like a bank mutual fund or something, then you're paying tax on the dividends, you're paying tax on the capital gains, and you're paying tax on like the interest income earned. Whereas all the investment money and all the income received in your tax-free savings account is not taxed at all. So it's a phenomenal vehicle, and I would especially recommend contributing to the tax-free savings account if you're a younger person or a low-income earner, because with the RRSP, you can minimize your taxable income per year and get to lower marginal like tax brackets, and I'll show you how to do that. However, with respect to TFSA, if you're in like an entry-level job, or you're a young person and you don't have that much, like you have a low salary and your income's not that high, you're already in a pretty low tax bracket, so it's not really worth it at this point to use your RRSP contribution room. It's better off just to contribute to your tax-free savings account and realize the investment gains and the investment income that you can earn. Because the distinction is that, as I've said, the TFSA, it's 100% like tax-free forever for all the gains. The registered retirement savings plans is essentially they're tax deferring. So you defer the tax at that point on the contribution, but you will have to pay it at your marginal rate eventually. So for TFSA, 2009, right after the economic crisis, the federal government, the Conservatives were in power at the time, and they wanted to encourage individuals in Canada to save more money and to keep more money in their pocket, because again, there's like a huge credit bubble and people were stretched beyond their means. And this was just a fantastic policy that the Conservative government put in to help Canadians save like a ton of money and not have to pay it in tax. So if you were 18 at the time that the tax-free savings account was originated, 2009, you were able to contribute $5,000 per year from 2009 to 2012, $5,500, 2013 to 2014, $10,000 in 2015 because there was an election in the upcoming year, and then it went back to $5,500 2016, $5,500 2017, 2018, and then it's now at $6,000 in 2019. So if you were 18 in 2009, your total contribution limit for your tax-free savings account right now, if you haven't put any money in it, is $63,500. And you can put money in at any time. You can take money out at any time, and it will be added back. Like any money you take out, it'll be added back to your contribution limit the next year. Fantastic tool. The only problem was when they were initially rolled it out, all the big banks said, oh yeah, it's great, and you just put some money in there and like watch it grow. As we've already talked about on this podcast, it doesn't grow just by sitting in the bank. You're actually losing money because of inflation. So you need to be able to hold marketable securities in your tax-free savings account, which you're allowed to do. You can use your TFSA to invest in mutual funds, exchange traded funds, stocks, bonds, REITs, so real estate investment trusts, you name it. So I personally have one registered at Questrade, and I hold some securities in there. I get paid dividends, and I get paid interest income on the fixed income investments that I have. And when I do sell like common shares and I realize a capital gain, don't have to pay tax on any of those returns. And it's fantastic. Love it. And in case I wasn't entirely clear, you do not have to contribute every single year to the TFSA. It's not like a use it or lose it sort of thing. If you've never contributed to your TFSA and you were 18 in 2009, you would have over $60,000 contribution room, because like it just keeps adding up and adding up and adding up. And then if you were under 18, like say you turned 18 in 2012, then you have basically the 2012 contribution limit up until like the 2019 contribution limit, and then it keeps like adding from there. So you missed out on like the 3 years from 2009 to 2012, but then you can just keep adding up the contribution limit. And on your income tax return, it'll tell you what your contribution limit is if you filed somewhat properly. So I would strongly encourage anybody, especially if you are at one of the big five banks and you hold like a mutual fund, ask them if it's in a registered account, because I bet you there is a lot of Canadians right now that have like mutual fund or like securities in like non-registered accounts, and they're paying tax on it, and they do not need to be paying tax on it. They can hold the exact same securities in non-registered account or in registered accounts, so in tax-free savings accounts, and not have to pay tax on the gains. But they do not get this type of advice when they just go into the bank. They say, oh yeah, great mutual fund, give us your money, put it in a non-registered account, and you can see those gains. Like, it's the dumbest thing ever, because the yield is not important. So like, oh, I'm getting 8% yield. The thing that matters is after-tax yield, and you're reducing your after-tax yield by not having it in a registered account. So I can get 5% yield versus 7% yield, but if the 7% yield is in a non-registered account, and the 5% yield is in a registered account or a tax-free savings account, I'd rather have the 5% in the tax-free savings account because I'm not paying any tax on the capital gains or the eligible dividends. And that's not an insignificant amount of money. It's capital gains tax at the top marginal rate is over 26%, and the eligible dividend tax rate is 39.34%, and eligible dividends are just for like big Canadian companies like the big five banks, telecoms, utilities, hydro, national CNR, just eligible Canadian companies. And then ineligible dividends are really just like foreign companies. So you're paying a little bit more for holding non-Canadian companies, but that's still, if you hold them in your tax-free savings account, you're not paying dividend tax or capital gains tax or tax on interest. So again, please contact your financial advisor or your representative at the bank and ask them whether or not your investments are being held in a registered account. So it'd probably be a good time now to talk about the other main registered account, which has been along for a lot longer, and it's the Registered Retirement Savings Plan. Federal government introduced this way back in the middle of the 20th century in order for employees that did not have defined contribution plans or defined benefit plans to adequately save for their retirement. The RRSP can be thought of as a tax deferring vehicle. So as opposed to the tax-free savings account, whereby you've already paid at the marginal tax rate and you never have to pay tax ever again on the money in that account, the Registered Retirement Savings Plan, you get to reduce your taxable income for the year of contribution, and you will be taxed when you withdraw the money. You can withdraw the money tax-free in certain life events. Like if you're a first-time home buyer, you can withdraw up to a maximum of $25,000. And if you're going back to school or you're in school, you can withdraw from your RRSP. And then there's like rules surrounding when you have to pay it back. There's like a 2-year grace period, and then there's periodic payments back. But that doesn't affect your Rsp Contribution Room. So what is the Contribution Room? Funny you should ask. I'm about to talk about it. So the Rsp Contribution Formula is as followed. 18% of the previous year's earned income is allowed to be contributed up to a maximum annual limit. The maximum annual limit is currently $26,500. You have to subtract pension adjustments, but you get to add any unused carry forward amount. So any, like the 18% up to that you didn't use in the previous years, it keeps getting added to your registered retirement savings plan, like the cumulative total that you're allowed to contribute. And the best thing about the registered retirement savings plan is that it reduces your income tax for that year. And the people use it to basically lower their marginal tax rate. You can jump, depending on your contribution room, you could jump 2, 3, even 4 income tax brackets and effectively pay a much lower marginal tax rate. It makes sense to do when you're in a very high income bracket and you want to lower the marginal tax rate you're paying, and you realize that when you take the money out of your RRSP, you're going to be in a lower marginal tax bracket because either you're going to be retired or you're going to be working part-time or you're going to be in a lower paying job, and you can take it out then and you'll have effectively paid a lower marginal tax, and you'll also realize the gains which you made in your RRSP. Again, you can hold any marketable securities in there and you can watch those gains grow tax-free while they're in the RRSP or while they're in the registered account, but you will be taxed on them as taxable income once you withdraw from the RRSP. So let's do an example. Let's bring back Jimmy. Remember Jimmy? He was super smart. He got out of his mutual funds and he invested into exchange-traded funds, and he saved hundreds of thousands of dollars on management expense fees throughout the course of his life. Well, now Jimmy's getting smart about income tax too. He realizes he can save even more money, retire even earlier. So Jimmy killed it at his job last year and he made $100,000. Technically speaking, his marginal tax rate is 43.41% if he made $100,000 last year. However, Jimmy, upon looking at his tax returns in the previous years, realizes that he has $25,000 in registered retirement savings plan contribution room. Jimmy says, you know what? I'm going to contribute $25,000 to my registered retirement savings plan this year. What Jimmy effectively did is A, lower his marginal tax rate that year by 13.76%. So he saved $13,760 in total income tax that year. And again, I'm using province of Ontario, but you can just look up the combined marginal tax rates in your province and see what the brackets are and see where you fall and how much you can reduce how much you can reduce your income tax by going down a couple brackets by contributing to your RRSP. So again, he will have to pay when he takes the money out, unless he's doing it to buy like a first-time home buyer or go back to school. But presumably he's going to try and keep the money in there for as long as possible. And then when he retires, so he's not earning earned income from like employment income, like he'll be receiving like dividends and such, but his marginal tax bracket will be a lot lower. And then you can withdraw and get charged on income. Plus, the money that's held in the RRSP, much like a TFSA, can be invested in any marketable securities. So you can hold exchange traded funds, REITs, bonds, stocks, and get interest income, get dividend income, and get capital gains, like sell off the really well-performing investments in the RRSP. And you're realizing all of those gains tax-free. And again, for those of you who are in non-registered accounts and like mutual funds at the big five banks and who have not maxed out their TFSAs and their RRSPs, it pains me. I'm just like, what are you doing? You need to max out and contribute to your registered accounts before you contribute to any non-registered accounts, because your tax savings, your after-tax returns will be so much higher than your after-tax returns in non-registered accounts. And again, going back to the comparison, like which one do I pick, TFSA or RRSP? It's a factor of how much contribution room you have, how much money you're making really. Because if you're making less than $43,000 in the province of Ontario, you can't get to a lower tax bracket at the marginal rate. So to the extent that you have TFSA room, you may as well just put it in there and then save the RRSP contribution room to when you're making more money, to when you're making income that puts you in the 3rd, 4th, 6th, 7th tax bracket. And then you could effectively look where you stand with your previous year's earned income and look at the tax bracket you are for that tax year and say, okay, I need to contribute this much to the RRSP to bring down my marginal tax rate to this tax bracket. And you will save hundreds of thousands, if not millions of dollars throughout the course of your investment career, as opposed to just putting it in a non-registered account at the bank, mutual fund, and having to get taxed on capital gains, dividends, and interest income. So hypothetically, if I reduced my tax rate and I saved on my tax bill $10,000 a year by contributing to an RRSP over 10 years, I'd have $100,000 and stick it at a low-cost S&P 500 index like VOO, 8% per year on average. Say I did that at age 40, and then I wanted to take it out at age 65 when I retired and I had no income. I would have effectively saved $800,000 in tax, like just on the growth of the investment. I would have saved $800,000, and then you will be taxed at the marginal rate when you withdraw. And at age 71, the RRSP automatically converts to what's called a locked-in retirement, like a locked-in retirement account or a LIRA, and you get paid annuities by like however much money you have in the account. Every year a prescribed amount has to come out, which is mandated by law. And you do pay at the marginal tax rate, but because you deferred so much tax and you're able to compound the investment growth within the account, it's well worth it. So I think that's good for a basic, like, introductory tax podcast. We discuss the defined contribution plans, defined benefit plans, TFSAs, and RRSPs. Perhaps if this podcast receives like decent reviews, we can go into a little bit more advanced tax planning and go into income splitting and like benefits of like spousal tax contributions. Like you can have a spousal RRSP. And fun fact, like if you're married, you're considered a spouse, obviously, like same sex or different sex couples. And also, if you're a couple in a conjugal relationship and you've been living together for 1 year, only 1 year, you're considered a couple for tax purposes. Whereas, like from a legal perspective, it's 3 years to be common law, but you're like a common law spouse for tax purposes only after 1 year, and you can realize some great benefits in terms of income splitting with your spouse and contributing to their registered accounts if they're making less than you. You can contribute to theirs. You can't gift them money, but you could give them a loan at 2% and take a promissory note in advance and put money right into their registered accounts. And we can talk about that in a more advanced tax podcast. But maybe before we go, we'll do the stock pick, and we'll also do this. It's blew my mind when I learned this the other day. You can buy a vehicle in Canada and not pay any interest. Like, I'm not talking about all these great promotions, or quote unquote great promotions that the automobile dealerships offer, like 0% MSRP, no money down for 36 months, blah, blah, blah. Like the cost of them financing the purchase of the vehicle is embedded in the price of the vehicle. So what you should do when you're buying a vehicle, it blows my mind that people in Canada don't know this. Like 99.9% of the population doesn't know this. So you're going to be like the 0.1% that knows this and knows how to just not pay any interest whatsoever on the purchase of a vehicle. So offer to pay the vehicle in cash. Bring in a financial calculator to the dealership. Ask them what their best finance rate is for the purchase. Say they're going to give you this interest rate over this number of years, and you have to put this amount down. So in the financial calculator, say, okay, the N, which is the time period, say it's 3 years, interest rate at 0.01%, and then the present value, you have to put down $15,000. Future value is 0 because you're going to be paying it off. And then your payment is whatever the monthly payment that they require. And then just compute that, and you can find out like what the value of that vehicle is. Like if you paid just in cash now and say, this is what I want to pay for the vehicle, it's the exact same as you would, effectively it's the same amount that you would make if you gave it to me financed. So offer to pay cash, you get a huge discount on the price of the vehicle because you're paying up front in cash. Withdraw it from your tax-free savings account, and with the money that you withdrew from the tax-free savings account, take out a loan from a bank, like a personal loan, like either a home equity line of credit or like a personal line of credit, and put whatever money you took out from the TFSA back into the investment account. Why do this, you ask? Well, the government lets you write off interest expense on investment money. So say you can tell CRA that you took out $40,000 in a personal line of credit at like 3% interest rate to purchase to put money into your registered account. So to put money back into your TFSA. Even though it's quote unquote 3% interest, and like the car dealership is offering, such a great deal, like super low, like less than 1% interest, you can write off the entirety of the interest that you pay on the personal line of credit in your taxes. Like you can get it back as a tax credit. So it's effectively what is called as a debt swap. So you're not having to take on any debt from the automobile company, which they're making money off you. I can guarantee that. And you're getting money effectively tax-free and interest-free from the bank by doing this debt swap. It's remarkable, and no one knows about this. Like I didn't know about it until like a week ago when a chartered financial planner I was at a lecture and they talked about this, and it's just like it seems like common sense to do this, but nobody does this. Everyone just goes for the dealership's price. So really, really remarkable stuff. And please reach out, Sean Moxon, if you have any questions, and LinkedIn, like send me a message. I'd be happy to provide some information on how you could get a car for essentially no interest. Like, obviously there's carrying costs involved, but anyway, maybe we'll go to the stock pick of the day and then call it. So my pick is Killian Apartment REIT, KMP.UN, listed on the Toronto Stock Exchange is the ticker symbol. And it's a real estate investment trust that they focus on just like apartments, so residential units and multi-family community development. And I'll just pull up some information here. So open-ended mutual fund trust specializing in the acquisition, management, and development of multi-residential apartment buildings and manufactured home communities. Their main operating areas are Ontario and Eastern Canada, so like the Maritime provinces. And they've just been performing fantastically well since they've started in 2010. They've effectively grown their company to a market capitalization of $1.89 billion. They have a very low price earnings ratio of 10.24, and they have a strong dividend of 3.21%. And they've been increasing that dividend consistently in the past 9 years since the company's been in existence. It's a very conservative play. You're not going to get much like capital gain growth from this company. It's particularly like it trades at $20.57 right now. And since they went public, well, the share price has doubled from like about $10 in 2016 to $20 in 2019. But they, like, on average, they're growing at like the share price is going up like $1 to $2 per year, which, again, if you're like chasing growth or you're chasing like tremendous capital gains, this isn't the company for you. But it's the Canadian like real estate market, residential space. There's an extremely, especially in Ontario, there's a extremely high demand and low supply. There's a supply shortage. So I think that they're going to be able to focus on their core business of providing residential homes for people for quite some time, especially since in Ontario, Toronto is the fastest growing city in North America, and people need places to live, and Killian Properties, they provide places to live. So I think that's good for today. Thank you so much for listening. I really appreciate it. Hope some of this was practical and you can be able to apply it in your own financial scenario. We'll look into it some more. I hope you have a great weekend. Thanks so much. Take care.